All right, let's get right to it. You have worked too hard for your money to let it just sit there. You need to put it to work, make it grow, and secure your future. One of the smartest, simplest ways to do that is with something called an exchange-traded fund, or ETF. I know it sounds complicated, but I want you to stop right there. An ETF is simply a basket of investments. Think of it like a shopping basket at the grocery store. Instead of buying just one apple or one loaf of bread, you buy a basket that already has a little bit of everything in it. Fruits, vegetables, grains, the works. That is an ETF, but instead of food, the basket holds stocks, bonds, or other assets. It's a way to own a small piece of many different things all at once. This is so important, so listen closely. The beauty of an ETF is that it gives you instant diversification. What does diversification mean? It means not putting all your eggs in one basket. If you buy stock in just one company and that company does poorly, you could lose a lot of money. But an ETF holds stocks from many, many companies. So if one company in the basket isn't doing so well, the others can help balance it out. This is a crucial step in protecting your money from the ups and downs of the market. It is a foundational rule of smart investing, and ETFs make it accessible to everyone, not just the Wall Street big shots. You are building a stronger financial foundation from day one. Now, you might be thinking, Suze, this still sounds like something for people with a lot of money. Denied. That is the old way of thinking. ETFs have opened the doors of Wall Street to Main Street. You can start investing in an ETF with a very small amount of money. You are buying a single share of the ETF, but that one share gives you ownership in all the companies inside that basket. It is a powerful tool that levels the playing field, allowing you to build wealth just like the professionals do. It puts you in control of your financial destiny, which is exactly where you need to be. You are the manager of your money, and ETFs are one of your best employees. So let's be very clear about this. An ETF is a collection of investments, like stocks or bonds, that you can buy and sell on a stock exchange, just like a single stock. It is designed to give you broad exposure to a specific part of the market, like technology companies or large US corporations, without you having to go out and buy each one individually. It simplifies the process, lowers your risk through diversification, and makes investing an understandable, attainable goal. It is about being strong, proud, and protected with your money, and an ETF is a fantastic tool to help you get there. You can do this. Okay, people get very confused about the difference between ETFs and mutual funds. They are similar, yes, as both are baskets of investments. But how they operate is very, very different, and you need to understand this. The biggest difference is how they are traded. A mutual fund is priced only once per day, after the market closes. So if you decide you want to buy or sell a mutual fund at 10 in the morning, you have to wait until the end of the day to know the price you will get. You are flying blind for hours, and in the world of money, that is not a position of power. You are giving up control over the exact price you pay. ETFs, on the other hand, trade just like stocks. What does that mean? It means you can buy and sell them all day long while the stock market is open. You see the price in real time, second by second. If you like the price at 5 minutes after 10 in the morning, you can place your order and buy it at that price. If the market starts to drop and you want to sell at 2:30 in the afternoon, you can do that too. This gives you incredible flexibility and control. You are not waiting around for someone else to tell you what your investment is worth at the end of the day. You see the price, you make the decision. It is transparent, it is immediate, and it puts you in the driver's seat. Let's talk about another key difference, the minimum investment. To get into many mutual funds, especially the good ones, you often need to come up with a lump sum of $1,000, or sometimes even $3,000 or more. For someone just starting out, that can be a major roadblock. It can make you feel like you are not welcome at the table. That is not okay. Investing should be for everyone, regardless of how much you are starting with. It is about getting in the game, not waiting on the sidelines until you have saved up a huge pile of cash. This is where ETFs are a true game changer. The minimum investment for an ETF is simply the price of one share. Many popular ETFs trade for $50, $100, or $200 a share. This means you can get started with a much smaller amount of money. You can buy one share today, another next month, and another the month after that. It allows you to build your portfolio piece by piece on your own schedule, with whatever money you can afford to invest. This accessibility is what makes ETFs such a powerful tool for building wealth over time. It removes the barrier to entry and says, yes, you belong here. Now we get to the good part, the powerful advantages of ETFs that can help you build long-term wealth. The first, as we have touched on, is diversification. I cannot say this enough because it is the bedrock of safe investing. When you buy a broad market ETF, like one that tracks the S&P 500, you are instantly buying a tiny slice of 500 of the largest and most successful companies in America. Think about that. With one single purchase, you are invested in technology, healthcare, finance, consumer goods, and more. This diversification helps cushion you against shocks. If one sector has a bad year, another might have a great one, smoothing out your returns and protecting your hard-earned principal. The second major advantage is low cost. You have to watch out for fees. Fees are like little termites that can eat away at your investment returns over time without you even noticing. Many mutual funds, especially those that are actively managed, come with high expense ratios. An expense ratio is the annual fee you pay for them to manage the fund. These can be 1% or even higher. That may not sound like much, but over 20 or 30 years, it can cost you tens of thousands of dollars in lost growth. You must be your own financial advocate and say no to high fees. This is where ETFs shine. Most ETFs are passively managed, meaning they simply track a market index like the S&P 500. They do not have a big, expensive team trying to beat the market. Because of this, their expense ratios are incredibly low. We are talking about fees as low as 0.03% or 0.05% per year. The difference between a 1% fee and a 0.05% fee is staggering over the long run. Choosing low-cost ETFs means more of your money stays invested and working for you, compounding year after year. It is one of the single most important decisions you can make to maximize your wealth. Finally, let's talk about tax efficiency. This gets a little technical, but the bottom line is what matters to your wallet. The way ETFs are structured means they tend to generate fewer taxable events, like capital gains distributions, than many mutual funds. When a mutual fund manager sells a stock for a profit, that profit gets passed on to you, and you have to pay taxes on it, even if you never sold your shares. ETFs have a unique creation and redemption process that helps minimize these taxable events. Over time, this can mean you pay less in taxes each year, leaving more money in your account to grow. Diversification, low costs, and tax efficiency. That is a power trio you want on your side. Okay, so you are convinced. You are ready to take action. How do you actually buy an ETF? I promise you, it is easier than you think. The first thing you need is a brokerage account. Think of a brokerage account as a home for your investments. It is an account you open with a financial company like Fidelity, Charles Schwab, Vanguard, or any of the newer app-based brokerages. Opening one is simple and can usually be done online in just a few minutes. You will need to provide some personal information and link a bank account to transfer money into it. This is your gateway to the investing world. Once your brokerage account is open and funded with some money, you are ready to shop for ETFs. The process is exactly like buying a share of stock in a company like Apple or Amazon. Every ETF has a unique ticker symbol, which is a short code of letters used to identify it on the stock exchange. For example, a popular ETF that tracks the S&P 500 has the ticker symbol SPY. An ETF that tracks the entire US stock market might have the ticker VTI. You simply type that ticker symbol into the trade window of your brokerage account. After you have entered the ticker symbol, you will see the current price of the ETF. Let's say one share costs $150. You then need to decide how many shares you want to buy. If you have $300 in your account, you could buy 2 shares. You will also have a choice between a market order and a limit order. A market order buys the ETF immediately at the best available current price. A limit order lets you set a specific price you are willing to pay. For example, you could set a limit order to buy only if the price drops to $149. For most beginners, a market order is simple and perfectly fine. Once you have entered the ticker, the number of shares, and the order type, you just click the buy or trade button. And that is it. Congratulations, you are now an investor. You own a piece of the market. Selling your ETF shares is just as easy. You follow the exact same process, but you click sell instead of buy. You have the same control to sell at any time the market is open. This simplicity and control is what makes investing with ETFs so empowering. It takes the mystery out of building wealth and puts the power directly into your hands, where it belongs. The world of ETFs is vast, but you do not need to be overwhelmed. For most people, starting with a few basic types is the smartest path to success. The most common and important type is the stock ETF, also called an equity ETF. These are the baskets we have been talking about that hold stocks from hundreds or even thousands of companies. You can get very broad, like with a total stock market ETF that owns a piece of nearly every publicly traded company in the US. Or you can get more specific, with ETFs that focus only on technology companies, healthcare companies, or companies that pay high dividends. For a beginner, a broad market stock ETF is a fantastic diversified foundation for a portfolio. The next major category is the bond ETF. Think of bonds as loans. When you buy a bond, you are lending money to a government or a corporation, and they promise to pay you back with interest. Bond ETFs hold a basket of many different bonds. They are generally considered safer and less volatile than stocks, meaning their price does not jump up and down as much. They provide stability and income to your portfolio. A good financial plan often includes a mix of both stocks for growth and bonds for safety. A bond ETF is an easy way to add that layer of protection to your investments. A third category you might hear about is the commodity ETF. These ETFs do not invest in companies. Instead, they invest in raw materials. We are talking about things like gold, silver, or oil. For example, a gold ETF will own physical gold bullion, and its share price will go up and down with the price of gold. These can be used to further diversify a portfolio because the prices of commodities do not always move in the same direction as the stock market. However, these are generally for more advanced investors. As a beginner, you must focus on building a solid base with stock and bond ETFs first. So, let's bring it all home. ETFs are a revolutionary tool for the everyday investor. They are diversified, low cost, and easy to trade. They allow you to build a sophisticated global portfolio with just a few clicks and a small amount of money. You can start with a broad stock ETF, add a bond ETF for stability, and build from there as your knowledge and confidence grow. The most important step is the first one. Do not be afraid. You are smart enough, you are capable enough, and you deserve to have your money working hard for a secure, beautiful future. Now go out there and own it.